Ever wish you could like get inside Warren Buffett's head?
Yeah.
See how he analyzes his businesses, especially during those like crazy market times?
Yeah.
Well, today we're diving into his 1987 letter to Berkshire Hathaway shareholders. It's like getting a private lesson from the Oracle himself.
Yeah.
Especially because, 87.
Oh, yeah. Big crash.
Huge. So he starts by talking about Berkshire's net worth. They were up a cool $464 million.
Okay.
But then he drops this truth bomb. He's not obsessed with book value.
Right.
He's after business value.
And that's a really important distinction. Think of it this way. Book value, that's like looking at a car's sticker price.
Okay, yeah.
It tells you something, but not the whole story. It doesn't tell you how many miles are on it, if it's been in an accident. Business value, that's like taking the car for a spin. You're getting a feel for what it's really worth.
Yeah, you're kicking the tires a little bit.
Exactly.
So how does Buffett explain this to his shareholders, though?
He uses some pretty stark examples. Companies like LTV and Baldwin United, right? They had impressive book values, looked great on paper.
Right.
But then PFD booed, bankrupt.
Gone.
Turns out their balance sheets weren't telling the whole story.
Wow. So big lesson there for investors, right?
Okay.
Big book value doesn't necessarily mean success.
Nope.
What about the opposite? Can a company have a small book value and still be a winner?
Oh, absolutely. Buffett points to Belridge Oil. Shell bought them out for $3.6 billion. But get this, their book value was only $177 million.
Get out of here.
Big difference. But Shell, they saw the potential, right? The ability to generate cash, make profits way down the line. That's business value.
Yeah, they saw beyond those numbers.
Exactly.
So back to Berkshire Hathaway in '87, what fueled their business value surge that year?
Two main things, according to Buffett. One, owning fantastic businesses. Two, having really, really smart people running them.
Yeah, I was going to say, it seems like he really puts a lot of emphasis on the people,
Oh, absolutely.
not just the product.
He calls his top 7 non-financial performers, he calls them the Sainted Seven.
I love that. Oh.
And you've heard of these companies, Buffalo News, See's Candies, Nebraska Furniture Mart. They're not just brands. These are profit machines.
And their combined return on equity that year, a whopping 57%. Now, for those of us who maybe didn't go to Wharton, break down what makes return on equity so important.
Sure. Return on equity, basically it tells you how good a company is at using their shareholders' money to make more money, to make a profit. So high ROE, like 57%, that means those Sainted Seven, they were firing on all cylinders.
No wonder he calls them saints.
Right.
But it wasn't just the numbers. He really seems, like I said, almost more impressed by the people running these businesses than the businesses themselves. He calls them even more remarkable.
He understood that to build a great business, you need passionate, skilled people.
For sure.
He saw these companies as more than just, assets on a balance sheet. They were partnerships built on trust, shared values, long-term vision.
It's a good reminder that behind every successful company are those talented individuals driving that success.
Yeah.
It's not just about the product, it's about the people.
Absolutely.
So we've got these Sainted Seven companies. But, Buffett, he doesn't strike me as the kind of guy who's chasing after the next big flashy thing.
No, not at all.
He seems to like things that are, a little more straightforward.
He likes those businesses that are, as he calls them, fortress-like. They've got that solid foundation.
Right.
They're not trying to reinvent the wheel, just, make the best darn wheel they can year after year.
And in the letter, he talks about how a lot of companies are constantly having to, adapt and change. Right. And that just seems exhausting.
Yeah, and risky. He mentions this Fortune study. They looked at companies with really high returns on equity over a decade. And guess what? Most of them, not in those, cutting-edge industries. They were in those kind of, boring sectors, the ones that people often overlook.
But what's the takeaway there? Like if you're looking for a business to maybe invest in, run away from anything that's exciting or disruptive.
I wouldn't say run away, but it's a good reminder sometimes the best opportunities are in those businesses that might seem, a little dull at first glance.
They're just quietly making money.
Exactly. Consistent, without all the fanfare.
Okay, so we've got the Sainted Seven, the fortress-like businesses, but this is 1987, the year of a major stock market crash. What does Buffett have to say about, dealing with that kind of scary time?
Well, he talks about this strategy that some investors were using called portfolio insurance. Sounded like a good idea, right?
Yeah, insure your portfolio.
Yeah, who wouldn't want that? But Buffett saw right through it.
So what was the problem?
It relied on timing the market, which he compares that to playing roulette.
Ooh, risky.
Basically, it forced you to sell as the market was falling, regardless of what those companies were actually worth.
Oh, so it's like everyone's panicking and they're just making it worse.
It creates this like vicious cycle. Buffett's argument, don't try to outsmart the market. Just own good businesses. That way, when there's a crash, and there will be, you can weather the storm.
He's all about the long game.
Always.
And he even uses that great analogy, Mr. Market, to explain this. I love that.
It's so classic Buffett.
It is.
So picture this, Mr. Market, he's this emotional guy,
Yeah.
shows up at your door every single day, wants to buy or sell you shares of a business.
Okay.
But his prices, all over the map, totally depends on his mood.
Sounds like a volatile business partner.
Right. And Buffett's point is, you don't have to play that game. You can ignore Mr. Market completely. Or, better yet, use his craziness to your advantage. Low price, buy. Crazy high price, sell. You decide.
So you're not letting the market dictate your moves. You're looking at the actual business.
Exactly.
You're making rational decisions.
It's a really key point from this letter. Buffett's not saying ignore the market. He's saying don't let it freak you out.
Right.
Don't let those short-term changes make you forget about the big picture.
So if you're not letting, like you said, Mr. Market dictate your moves, how do you decide when's a good time to buy or sell?
Well, Buffett says Berkshire, they approach buying stocks the same way they'd approach buying a whole business.
Makes sense.
They're not looking for a quick buck.
Right.
They want companies they can hold on to, for the long haul.
He is all about the long game.
Mm.
But are there any companies that he just considers like completely untouchable? Holdings he would never sell no matter what.
He actually addresses that in this letter. He talks about 3 companies that Berkshire considers permanent holdings. Capital Cities, ABC, Geico,
Oh,
and the Washington Post.
big names. What makes them so special, though?
He sees them as more than just investments, more like, long-term partners, you could say. He admires their business models, their management teams. He thinks they've got incredible long-term potential.
Yeah.
He even says he wouldn't sell these holdings even if their price got, temporarily inflated.
Wow. That's a serious vote of confidence. He's basically saying, I believe in these businesses no matter what.
Exactly.
Wow.
He's got that long-term vision. But, he's always looking for that next great opportunity, too.
Of course. Wow.
In fact, this letter, it almost reads like a businesses wanted ad.
So what's he looking for? What's on Buffett's wish list?
He's pretty specific. He wants large companies. For one, proven track record of profitability,
Right.
strong management teams already in place, businesses with low debt, high returns on equity, those consistent profit makers.
He's not looking for a fixer-upper.
Nope. He wants those businesses that are already humming along.
Yeah.
And just as important as what he wants is what he doesn't want. No turnaround projects, no bidding wars, definitely no hostile takeovers. He's all about those win-win partnerships.
Where everybody benefits
Exactly.
for the long term.
So as we kind of wrap up our deep dive into this 1987 letter, any final thoughts? What are some key takeaways you hope listeners will remember? I think this letter, it's got some really timeless wisdom in it for any investor. It's about, not getting caught up in the day-to-day ups and downs of the market,
Yeah.
focusing on those fundamentals, finding those rare companies that are built to last.
Playing the long game.
Exactly.
Thinking like an owner.
Thinking like an owner.
Not just someone, trying to make a quick buck.
And remembering that behind every great business, there are those passionate people, those talented people driving that success.
It's not just about the product. It's about the people.
Absolutely.
Well said. Well, this has been fantastic. Really appreciate you taking this deep dive with me. Always fascinating to get your insights.
Always happy to geek out about Buffett with you.
Yeah.
Anytime.
I'll hold you to that.